With inflation running at 7% in the US, this makes real interest rates close to negative 5.5%, meaning that investing in government bonds guarantees you a loss of purchasing power. The Fed says they're going to get this under control by raising interest rates, which in theory fixes this issue. Not according to my guest in this episode of GoldCore TV, Rick Rule, investor and founder and CEO of Rule Investment Media, who sees some catastrophic implications for financial markets. And as a result, some significant upside potential for precious metals. Watch this interview till the end, where Rick shares details of a very special offer for GoldCore TV viewers. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Rick Rule, welcome to GoldCore TV.
David Russell, thank you for having me on.
You're very welcome. You're very welcome. And thank you for your time. Traditionally now, bond markets have been known as the risk-free return. And increasingly recently, I've heard you say you've called them the return-free risk. What exactly do you mean by this? And what does that mean for markets and for investors?
You're leading with the $64 trillion question. For the last 40 years, we as investors have lived in a very benign climate. The interest rate has continually fallen, which means that the cost of capital for both consumers and businesses has consistently risen. Credit quality is increased simply because affordability has increased as the price of money has fallen. But some of the decline in interest rates, I would argue with you, has been artificial, which is to say quantitative easing, the setting of unrealistically low interest rates because of political or central bank intervention. And the consequence of that is that the probability of interest rates falling anymore is, I would suggest, very low. Think about the concept of negative real interest rates, David. That would be you foregoing consumption for 5 years or something, giving your money to me to enjoy now, taking the credit risk around my paying you back and paying me to take your money. That's what negative real interest rates are. And the probability that negative real interest rates could continue very long if savers operated under their own free will without government constraint, I think is very improbable. The combination of low nominal, negative real interest rates and the re-emergence of inflation is problematic for bondholders. Let's look at the arithmetic, and I'm sorry I can't give an English or Irish example, but let's look at the concept of the U.S. 10-year Treasury, which is the largest and most liquid savings product in the world. That instrument yields, as of this speaking, about 1.65%. The government absolutely promises that if you give them $100,000 or some number like that, they give you 1.6% a year for 10 years. And they will, because they don't have to borrow or earn the money they pay you back. They can print it. The difficulty with that is that the purchasing power of the capital that they pay you back is declining at 6.5% a year, which means that the US government has sworn a solemn oath to make you, in terms of purchasing power, between 4.75 and 5% poorer every year for 10 years. You're taking the credit risk around the US government, which I would argue, given their printing power and the size of the US military force, is probably pretty good, but they are guaranteeing you a loss of purchasing power over 10 years. I've been an American citizen now almost 69 years, and I can say with some confidence, this is the first promise they've made me that I think they'll absolutely keep. If I lend them money, they'll make me poorer. The problem is that's not a very attractive alternative. And that problem, writ large, manifests around the world. The biggest institutional investors in the world for the last 40 years have been trained, first of all, to buy the dips because the governments have their backs, but also to maintain investment portfolios that were roughly 60% equity, 40% debt, or 40% bonds. Imagine yourself now running, say, Norges Bank, the Norwegian Sovereign Wealth Fund, and you're responsible for the well-being of Norwegians 25 or 30 years ago, or pardon me, from now, when the oil runs out. And imagine waking up with the realization that 40% of your portfolio is denominated in assets that will reduce your purchasing power. You have an obligation to people 25 years from now, and 40% of your portfolio is geared to make sure that you renege on your promise. Mm-hmm. It's going to be, well, it is an interesting challenge for the biggest portfolio managers in the world. The idea that they're getting a 1.6% yield or a 2.5% yield in a currency or in a basket of currencies where their purchasing power is declining by 6.5 or 7% annually means that they are going to have to step out of what has for 40 years been their comfort zone around their bond portfolios. The longer the portfolio, of course, the worse outcome. The secondary problem around this, both for British banks, unfortunately, and for American banks, is the availability of capital to their borrowers from time spreads necessarily becomes a problem. Think of the great big money center banks as, in one sense, extraordinarily large hedge funds with very low cost of capital, where, as an example, they'll make a loan for 5-year duration. 5-year money has a higher interest rate than overnight money. And they fund that 5-year loan with demand deposits and overnight funds. It's an awful lot of fun lending money out at 4 or 4.5% when you're funding that loan with 25 basis points money. But if the 25 basis,
you're just making money hand over fist at that stage.
Yeah,
it's easy. It's easy business.
Correct. And that's been the basis of a lot of the availability of cash, first of all, in the market. But it's also been the basis of the extraordinary profitability that you've seen in the money center banks relative to some of the big write-downs that they had to take in other aspects of their business. If you have a circumstance where there's a crisis of faith, like 2008, in other words, where the flow of interbank funds dries up and they can't fund this activity in the overnight market, the banks blow up. And if the circumstance occurs where their longer term obligations are at fixed interest rates, but the money that they borrow, in other words, their interest cost rises, they're also in a world of hurt because the activity that they are undertaking is so leveraged. I'm a credit guy myself. Actually, I'm probably better known as a speculator, but the truth is, at heart, I'm a good old-fashioned corporate loan shark. And the whole structure, I think, of these markets, the whole structure of the institutions, the endowments, the pension plans, the insurance companies, lending very long in obligations that return them less than what should be regarded as their cost of capital, is problematic for me, and it's going to be problematic for them. And the whole structure around the money center banks, where they have lots of 5 or 6 or 7-year obligations. In the United States, some of them actually have 30-year fixed mortgages on the books that they're funding in overnight credit markets. And that system, I'm not trying to say the system's going to blow up. All I'm trying to say is it's very fragile. And over time, the people who are responsible for allocating that capital, either at the money center banks or at the very large institutions, are going to have to deal with disintermediation in the bond market. And that is an enormous challenge.
Yeah. So if I just kind of summarize, in order for the economy to maintain growth, effectively what we need an upward sloping yield curve where it can be lent long, borrowed short, and banks are encouraged to make money. But then we've got this added problem at the moment on the short end when we've got inflation running at 6.5+%. And the challenge is then that if central banks are trying to address that problem, which is a serious problem and an immediate problem, that the risk of inverting that yield curve comes in, and then we're back to kind of square one.
Well, if you invert the yield curve, if the if the short-term rates, the funding rates end up being higher than the funded rates, the banks have a real problem. They're upside down. The other problem that you described, which is to say the economy's or the government's ability to withstand higher interest rates, is a different discussion. And of course, it's real. Again, if you look at the US 10-year Treasury and you look back over 30 or 40 years, traditionally, you could argue at least that it paid a positive real rate of interest, which is to say that the return was above the rate of the deterioration of the currency measured by the consumer price index. The implications of that, the implications of a reversion to mean there are interesting too. The interest component paid by the US government and by state and local governments, and of course by European and the British government, are brought down by low interest rates. Similarly, corporations enjoy a low cost of capital and consumers enjoy a low cost of capital. If you had a reversion to mean in terms of interest rates, which is to say that borrowers demanded a real rate of return, the shock to the economy would be interesting. If you looked at the US 10-year Treasury and it paid a real rate of return, rather than yielding 1.6 or 1.7, it would have to yield 8 or 8.5. The implications of a quadrupling or quintupling of the interest bill that would face governments. The US government, as an example, is $30 trillion, 22 or 23 trillion net of their own balance sheet. The idea that you quadruple the interest payable on that at the federal, state, and local level is interesting. And if you really want to scare yourself, and that's not my purpose today, but if you really want to scare yourself in the United States, traditionally the 30-year fixed mortgage has traded at a premium to the yield on the US 10-year Treasury. Right now, 30-year fixed mortgage rates in the United States are, in the low threes. If you traded the 10-year at a real rate of return, which is to say in the mid sevens, and you priced the 30-year mortgage at a premium to that, if home buyers were paying 8 rather than 3.2% on their 30-year fixed mortgages, it would have an amazing impact on the US housing market, one that might be pleasant for all cash buyers, but one that wouldn't be particularly pleasant for existing homeowners who wanted to sell. So I'm not sure how much room there is in the economy for a normalized interest rate environment without an enormous cleansing. We had an enormous cleansing. You may be too young, but I'm sure some of your listeners won't be too young. We had an enormous cleansing in the 1980 to 1983 period when Mr. Volcker came in and decided that he would slay inflationary expectations, which he did. He did in a way that decimated the housing market, decimated employment markets, decimated auto sales, but he got the job done. I lived through it. And it reminds...
There isn't the political appetite for doing something similar now, though, is there?
I don't believe there is. So I would suggest that the policymakers, and to a different extent, investors, are stuck between that proverbial rock and that proverbial hard spot. The interest rates have to go up, but the interest rates can't go up.
Now you gave the example there of the Norges Bank fund managers with their 60-40 portfolio, and at some stage come to that realization that money is going to have to move out of the bonds and into something a bit more real that offers them the opportunity at least for return in the future. You're obviously very bullish on gold and silver. Talk to me about how precious metals fits in to this conundrum that we have at the moment.
Sure. I mean, traditionally, precious metals have done very well during periods of time when savers and investors were concerned about the maintenance of purchasing power of their savings. There are other reasons why gold and silver have done well too. But when I look back over my career, which goes back to the beginning of the 1970s, when there have been periods of time when savers and investors were nervous about the maintenance of purchasing power, precious metals have done very well. I remember instructively, the decade of the 1970s, At the beginning of that decade, we'd come off really 2 decades of uninterrupted growth post-World War II. Another very, very, very benign period. Interest rates were low, economic growth was high, all that kind of stuff. We had all kinds of borrowed money. And the interest rate relative to the inflation rate was low. Beginning really in 1966, we had inflation in the United States that exceeded the interest rate that was being paid on deposit products and savings. The very low interest rates also subsidized equities in the sense that the dividend yields were competitive with savings products because the savings products didn't pay very much, something eerily similar to today. When they decontrolled the gold price, gold reacted almost like a coiled spring. Well, that's not true. It took 2.5 years or something like that from the beginnings of the insurmountable evidence around inflation to inflationary expectations among the population. There was a lag time because people lived through 2 decades of benign economic climate. But when gold started to move, of course, from a price-controlled bottom, it moved pretty dramatically from $35 an ounce in 1970, if my memory serves me correctly, to $210, $212 an ounce in 1975. In 1975, the US Fed famously allowed interest rates to rise, which strengthened the US dollar and took the gold price from $200 to $100. A really, really, really ugly cyclical decline in a secular bull market. That increase in the interest rate at the same time that, remember, the US government was trying to win both the war in Vietnam and the war on poverty and pay for both, was unsustainable. The Fed lost its nerve, backed off on the interest rate, and gold went on a romp from $100 an ounce to $850 an ounce by the end of the decade. The point of this isn't really to recite history, but rather to say that the gold price is pretty sensitive around real interest rates and their impact on the strength of the currency. So if you are one that believes that the governments will be able to continue to have their way with markets and through quantitative easing and other measures, keep the return that savers enjoy, if that's the right phrase, for their savings below the rate of destruction of their currency, I think you almost have to be bullish about gold. Let's look at some of the drivers. The first driver, of course, would be quantitative easing. David, if you did it, it would be called counterfeiting. If you printed up Russells and attempted to introduce them as a medium of exchange with no backing, you would be rightly thrown in prison. When Parliament does it, it's policy and it's widely applauded. In the US government, in the last 2.5 years, the float of US dollars has increased by almost 40%. A rate of increase that I would suggest is not dictated by the growth in the economy, but rather the needs of the legislature. So quantitative easing, really truly defined as counterfeiting. And if anything should make you concerned about the efficacy of the currency, the fact that the legislature can increase the float by 40% for no apparent reason should make you concerned, I think. The second is debts and deficits. And I don't want to give a British example, but in the US, the on-balance sheet liabilities of the federal government are almost $30 trillion, or 22 net of their own balance sheet. They're servicing this debt with a budget that's in deficit $3 trillion a year, which is to say, rather than servicing the debt, rather than amortizing the debt, they're adding to the debt. More challenging in both your country and mine are the net present value of off-balance sheet liabilities or entitlements. Medicare, in your case, the National Health System, Medicaid, things like that. In the United States, that number, according to the Congressional Budget Office, not some cranky old libertarian saver, exceed $120 trillion. So if you add the $22 trillion in on-balance sheet liabilities with $120 trillion off-balance sheet liabilities, you come with a rather eye-popping $140 trillion of net present value of future obligations, serviced by a budget in deficit. And then you look at the credit quality that's manifested by that, and you accept that risk for a negative real interest rate, which is to say you lend money to a debtor, the US government, who has acknowledged that they can't pay it back, and you don't demand a real rate of return on your savings. You take that implied credit risk, you assume the destruction of the currency, and you lend your money at 1.6 or 1.7 in a world where your purchasing power is being destroyed at the rate of 6.5. And anybody who isn't concerned about the maintenance of purchasing power in their savings in that circumstance is somebody who doesn't understand very much about the fundamentals of arithmetic.
Mm-hmm.
It's very difficult to subtract 6.5 from 1.6 and come up with a positive sum, at least from my point of view. And then if you manifest those three concerns with two notes, one we've gone through before, which is to say that 40% of the savings and investment assets of the biggest investors in the world is comprised by debt instruments, which are now guaranteed at this interest rate to lose the money. At the same time that the political forces can't allow interest rates to rise enough to give them a positive rate of return. And the second, which is the extraordinarily low market share of gold and silver as savings and investment assets relative to historic norms. And let me do the arithmetic for you there too. It's estimated in the United States. By the way, I understand that you opened a location in the United States, so welcome.
Thank you very much.
In the United States, it is estimated that precious metals and precious metals related investments comprise a little less than 0.5% of the total value of savings and investment assets in the US market. Interestingly, that compares with the 30-year mean of between 1.5% and 2%. So if the combination of quantitative easing, debt and deficits, and negative real interest rates causes people to be concerned about the maintenance of their purchasing power in other savings and investment assets, and they act just a little bit, gold doesn't need to win the war against bonds. Gold doesn't need to win the war against savings products. It just needs to lose it less badly. If the market share of precious metals and precious metals related assets in the United States reverted to mean, demand would triple or quadruple. And so for those reasons, sadly, because precious metals do well when other things do poorly, and I would love everything to do well, for those reasons, I'm more, I think, than fairly bullish about precious metals. I would caution your listeners to understand that when people buy into this narrative, they buy into it too well.
What do you mean by that?
The nice thing about precious metals is when they move much further than people would expect. So if you're looking at gold and silver as lifestyle or portfolio insurance, a little bit goes a long way. If you had a circumstance where precious metals mimicked the activity in the first two bull markets of my career, 1970 to 1981, where the gold price went from $35 to $850 an ounce, or the tame bull market of the first decade of the 2000s, where the gold price went from $253 to $1,900. What you understand is that a little bit goes a long way. 10% of your portfolio in precious metals can probably shelter the depredation that will occur to the 40% of your portfolio, which would occur in bonds if you were a traditional investor. Too many investors hearing this narrative go all into precious metals. They go 100% into precious metals. And that denies the fact that while these bull markets are traditionally of very long duration, 10 years, they're extremely volatile. And most investors, if they're all in, don't have either the psychological or the financial staying power to face even a 20 or 25% decline. History shows us that a 10-year bull market will be punctuated by at least 4 25% declines. In the first bull market of my career, as I told you, I suffered through a 50% decline in 1 year in 1975. And I have to say, it shook the faith. It's easier to have the financial and psychological staying power of a market that has that much volatility and that sort of periodicity. If you're 10% involved or 15% involved, it's much more difficult, as it should be, if you're 100% involved.
So historically, what you're saying is basically the precious metals have performed that role of financial insurance, but you have to measure that, and 10%, or 10, 55%, 10%, 15%, whatever it is you decide. It's not a case of going all in, because once you go all in, it's a speculative investment, and you may not have the appetite or the depth of wallet to be able to wear that, and you'll end up, as you say, losing the faith.
Yeah, that's exactly right, David. I would encourage all of your investors and all of your listeners, in fact, to consult some of the historical charts. I use the Barron's Gold Mining Index myself, which is a 60-year compendium of gold equities indexes. And not because I'm a technical analyst, I'm not. It's a wonderful pictorial representation of the anatomy of bull markets and bear markets. It's a wonderful picture of the periodicity and also a wonderful picture of the volatility. And if you look at this chart for 10 or 12 minutes a quarter to reacquaint yourself with the periodicity and the volatility, you will be better equipped psychologically to deal with the vagaries of this market. Similarly, if you understand why you own gold and you refresh your memory as to why you own gold periodically, not just because it goes up, but rather because of quantitative easing, debt and deficits, and negative real interest rates. If the reason that you bought precious metals are the 5 reasons that I've enumerated, the time when you might sell precious metals becomes very obvious. When the factors that were the reasons that caused you to buy gold go away, the gold should go away too. Too many people, oddly, buy a financial asset. It increases in price, which means it becomes less attractive relative to other financial assets. But the fact that it increased in price validates the narrative. When the gold price falls and it becomes arithmetically more attractive, the fact that it's fallen begins to negate the value of the narrative in the mind of the holder. So while your listeners might be extremely rational customers when it comes to buying automobiles or coats, which is to say you would prefer to buy a physical asset when it was cheaper on sale, ironically, financial assets often motivate people to overpay. That is, when the price action in an asset class justifies the narrative, they will buy in a market which is becoming overpriced. And oddly, when the goods that they want to buy go on sale, the fact that they go on sale shakes their faith and they sell some of what they already have. And I think it's important for gold investors to think through why they own it, to attempt to overcome the conundrum of recency bias and the fact that the narrative is often justified wrongly in people's minds by the price action.
Would that suggest then that in your situation, given the examples that you've given, or the reasons that you've given for holding gold, is that you're going to hold gold until those reasons go away? I
am.
Okay.
I am. Which means, frankly, I'm pushing age 69 very, very, very hard. It wouldn't surprise me if I held gold until I was 80. It's difficult for me to understand how a real recession or depression, hence a real upset in Western economies, it's difficult for me to understand how in the next decade we can afford the return to real interest rates, how the legislature, either Congress or Parliament, can resist the temptation around quantitative easing. It's just very difficult for me to understand how this circumstance unwinds. It isn't difficult for me to see a circumstance. Don't hear me saying this is a price forecast.
Sure.
It's not difficult for me seeing demand for precious metals over 5 years quadrupling or quintupling, which means I wouldn't be at all surprised to see $5,000 or $6,000 or $7,000 gold or $1,000 silver. That's not a price forecast, but I lived through the decade of the 70s. I lived through circumstance where retail establishments such as yours had block long lines. in front of them. And a situation where gold and silver so far outpaced the circumstance in the economy is one that would find me a seller of gold, not a holder of gold. But we're a long way from there so far. And
I'm not going to hold you on these price predictions, but you suggested 5, 6, 7, 8,000 gold and $1,000 silver.
100. You added a zero.
Okay.
The want of a bullion dealer.
Fair enough. Let's just talk about silver for a moment, and distinguish it from gold in terms of the position in your portfolio or the position it should hold in a portfolio, and maybe talk to that for a second.
I need to give you a disclaimer, because some of silver is around narrative and market psychology, and that's not what I am. I'm a credit analyst. There are great reporters who understand the value of the narrative in society. I'm not one. I require my wife's aid to get dressed. It's just not something I do well. But I'm an okay historian now that I've become older. Silver seems to move in the second half of a bull market. It would seem to me that the establishment of the validity of the narrative is led by the fear buyer, somebody who buys gold for the classical reasons to protect themselves. And in the first half of the two bull markets that I've lived through in my life, gold has driven and silver has lagged. Mm-hmm. When the momentum in the price in the second half of the market, or even in the third of the market kicks in, then silver moves further and faster. The lower unit price of silver, as an example, gives the bottom half of the world's population, measured by economic clout, the ability to participate in the inflation narrative. A poor person in India who sees their rupiah depreciating by 20% a year and being rewarded with a 3% savings rate, it may be that the unit cost of gold at $60 or $70 a gram is too high for them to participate. And that great hunk of mankind can only participate in the narrative in something with a lower unit cost, which is to say silver. Similarly, the speculators are drawn to the volatility of silver. And after the narrative has been driven by gold, the speculators look to the historic outperformance of silver relative to gold, and of course become attracted to silver in the second half of a bull market. I don't know why this is, David. I can tell you why, in terms of interest rates, precious metals should do well. I don't know why the relative underperformance of gold in the first half of a bull market and the relative outperformance, the relative underperformance of silver in the first half of a bull market and the extraordinary outperformance of silver in a second half of a bull market occurs. I can only tell you that I've experienced in very dramatic fashion twice in my life, and I, with some horrid fascination, look forward to experiencing it again.
Given your professional background, you are very much a fan of physical silver and physical gold, physical precious metals in general, holding them and investors holding them. We at GoldCore, as I've discussed with you before, hold it in a segregated, allocated basis using professional third-party providers. That's something that you recommend also. Can you explain why it is that you recommend that?
I do. I own gold myself for risk avoidance. I look at conventional financial assets as being in some way riskier than the rest of society. And the idea that I would add to rather than delete my risks seems odd to me. Many Americans, and I can't speak for British people or Irish people, but many Americans believe if you can't touch it, you don't own it. Which means that they take physical delivery from a shop like yours, and they engage in an activity that I laughingly refer to as midnight gardening, which is to say that they try and keep gold and silver on the premises. And inexplicably, they often mention this to other parties. which means sometimes those other parties visit them at inappropriate times with weapons to relieve them of their physical gold and silver. The introduction of the type of risk that happens when you engage in self-storage or midnight gardening is, to me, unacceptably high. Unallocated storage. If the dealer that is selling the unallocated storage or providing the unallocated storage isn't public, is an unacceptable risk. Unallocated storage means you don't actually own the gold and silver. What you are is an unsecured creditor of the dealer or the storage facility. And if you can't see their balance sheet and their income statement on a quarterly basis to understand that they're a good credit risk, you can't afford to be an unsecured creditor where you don't know enough about the value of the other credits against the collateral that you have. Remember, in unallocated storage, you are a hypothecated creditor. You're an unsecured creditor. And being an unsecured creditor where you don't understand the credit quality of the risk is stupid. It's just plain stupid. So from my viewpoint, the way that you mitigate the risk around holding physical gold and silver is that you have the contract between yourself and the storage facility that's owned at the very least by a public company, so that you can quarter by quarter by quarter look at their balance sheet and look at their income statement. Because even in the case of allocated storage, if you own it in a facility that goes bankrupt, you can have an awful lot of difficulty sorting out your claims from the other claims and recovering your metal. There were circumstances in the United States in the second half of the 1970s where people who had allocated metal in facilities where the facility owner himself or herself went bankrupt, the ultimate owner of the allocated metal required 12 to 18 months to secure their metal from the bankruptcy court, which is unacceptable to me.
Mm-hmm.
I have also personally held bullion in safe deposit boxes in chartered banks, where I had some faith in the solvency of the chartered bank. Many people don't like that because they're afraid of bank holidays or, whatever that sort of thing is. I'm probably more tolerant of that risk.
Mm-hmm.
The only thing that I can say there parenthetically is understand that those safe deposit boxes are designed for wills and trusts and passports. The gold and silver are very heavy. And so if you are going to put gold and silver in a safe deposit box, get the lowest box on the stack. You don't want a circumstance, which I've seen before. You don't want a circumstance where the combined weight of various people's bullion holdings collapses the stack of safe deposit boxes, and it's difficult to ascertain whose gold and whose watches are where. It sounds funny, but there was a circumstance here in Vancouver, British Columbia, where I am right now, where there was an independent storage facility in the 1970s, safe deposit facility, and the consequence of the physical construction of the safe deposit boxes was such that enough weight of gold was entered into them. Remember that at that point in time, gold ownership was illegal in the United States, so Americans would come up to Canada and store it here. Anyway, it tore the stack of safe deposit boxes off the wall and collapsed them. And there was a tremendous mess on the floor of this dealer where everybody's, quote, secret assets were commingled.
Wow.
And well, it's funny to me.
With sure no independent record of exactly whose was whose.
Great. So it's important that people think about this. I did this partly to regale your audience, but partly to reinforce the fact that if you are into precious metals for risk mitigation, think through the whole process of risk mitigation and mitigate every risk that's controllable.
Yes, I mean, that's exactly why we do it the way we do it, which is fully segregated, fully allocated, with third-party providers, where none of the bullion ever sits on our balance sheet whatsoever. It's ultimately owned by the holder of that bullion, and with a look through into that facility so that they can verify with all individual account numbers and holdings.
And of course, at Loomis and Brinks, the facility operator is also public.
Mm.
So you get a sense of their solvency. And if they have a couple of bad quarters in a row, you can withdraw your medal.
Yeah.
Their solvency becomes somebody else's problem, not yours.
We're singing from the same hymn sheet, Rick. Before we wrap up here, I'd like to know a little bit more about what it is that you're doing and how our audience can find out more about what it is that you're doing.
Well, the first thing I'm doing is retiring, which is lovely. I've given up any regulated activity, which is to say
You seem to be working very hard for a man who's retired.
Well, I have a different definition of retirement than some. I don't do anything that doesn't amuse me. I like teaching and I like mentoring, so I do things like this. And I also now enjoy commercial freedom of speech, which I didn't when I was in a regulated capacity. I also don't enjoy administration. I've gone from a couple hundred employees to one, and I report to her, as you may have seen in scheduling this, which is great. I'm building something called Rule Investment Media, which so far is all cost and no income. Odd way to build a business. And I'll do something with it someday. I don't know what it is, but the way I'm building it is I offer audiences like this the opportunity to have me personally rate and rank their natural resource portfolio.
Wow, okay.
If you go to my website, ruleinvestmentmedia.com, and list your natural resource stocks, if I know about them, I will rank them 1 to 10, 1 being best and 10 being worst. On individual issues where I think my opinion might have some value, I'll include a short commentary on the company. This is not to be construed as investment advice because I don't know all your listeners. This is just comments on companies and how I see them as investments. If any of your listeners care about the charts I mentioned, if they mention charts in the question and comment section, I'll send them the Barron's Gold Mining Index chart, which is the best illustrative representation of 60 years of bull and bear markets in precious metals that I know. And I'll also include a 110-year commodity chart from Goldman Sachs, which talks about the relative valuation of commodities versus other asset classes, going back more than a century. The second thing that I'm doing, which amuses me greatly, is in my declining years, I'm starting another bank. I'm backing a group of people who founded a US bank called Everbank, which was first of all a 30 to 1 shot, which will tell you one of the reasons why I'm doing it for the early investors. But it's a bank that was enormously successful. When I talk to investors, myself included today in the United States, and I ask them, I've probably talked to 1,000 people. I say, are you satisfied with your current banking relationships? Right now, I have no yeses and 1,000 nos. And I'm enough of an entrepreneur to know that when the services offered up by a whole asset class are negative, that there's room for an entrepreneur.
Yes.
In the former incarnation of Everbank, we pioneered online banking. We didn't have any branches. The consequence of having a lower cost structure is we could pay in the upper decile in terms of deposit rates, while at the same time focusing on lending niches that we understood well enough that our loan losses were much smaller than other people, and we could earn a decent rate of return. And we grew that bank from 0 to $28 billion in AUM, listed on the New York Stock Exchange, and then sold it to TIAA-CREF. So I'm building a new bank, or pardon me, I'm backing a younger team building a new bank. And I think it will come as no surprise to you that one of the principal deposit and lending activities will be around physical precious metals. But we will also, which we pioneered for US savers, offer federally insured certificates of deposit denominated in Great Britain, in British pounds, in euros, in yen, various index-linked CDs. In other words, it's a bank that's built around the needs of the depositors and borrowers, rather than a bank that's built around the needs of the bankers. So if any of your listeners care about this bank project, if they look forward to being either a depositor with us and enjoying above average interest yields, or a lender, or a borrower, borrowing against, as an example, physical precious metals or something like that, you are encouraged in the submittal, the ranking submittal, to write the word bank. Finally, I'm enjoying my commercial freedom of speech. Because I participate in a lot of private placement financings, and I couldn't talk to audiences about that before because these are unregistered securities, and I was then accused of soliciting. Now, what's occurred to me is because I don't receive any compensation, I can tell accredited listeners, which is to say listeners that qualify to participate in private placements, the ability to see what private placements I'm participating in, because I'm not a broker. I don't charge a fee. I don't charge the company a fee. I don't charge the viewer a fee. So anybody who wants to know what private placements, either debt or equity, that I'm participating in, can say, again, in the rankings form, placements, and I'll put you on a private placement list. Whether or not you should invest in these private placements is a very different circumstance. This isn't about recommendations. This is simply about what I'm doing with my own money. And it amuses me greatly to do this.
Fantastic. Well, what I'll do, Rick, is I'm going to put a link to your website in the show notes in the description below this video. And whoever wants to click on that and rewatch this video and get the points that Rick says of what you need to put into that box in order to get those various different things. And hopefully we send a few of our watchers and our audience your direction. But for now, Rick Rule, thank you very much for joining us on GoldCore TV today.
Well, thank you. It's been a fun discussion. I'm sorry for my long-winded answers, but you asked me very big questions.
Thank you. Thanks for watching. In this episode, we talked about the importance of how your precious metals are stored and managing the counterparty risk involved. As Rick Rule says, if you're investing in precious metals to mitigate risk, you want to be sure that you're doing it in the safest way possible. That's why here at GoldCore, gold is stored on behalf of our clients on a fully allocated and fully segregated basis using publicly quoted storage companies that specialize in the storage of precious metals. Precious metals always remain the property of the beneficial owner, you, the investor, and are never part of our balance sheet. This is vital, regardless of who you trust with the storage of your precious metals. If you want to learn more about this, as well as how to buy, sell physical gold and silver, log on to GoldCore.com, your precious metals experts. And if you enjoyed this video, check out some of these recent interviews that I've done with the likes of legendary investor and adventure capitalist Jim Rogers, or silver guru David Morgan. Go check them out now. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now.